Hello and welcome to Ticker Tapes. Today we're back in the world of ETFs. Bank of America publishes a weekly report known as the Flow Show, which aims to track where investors are putting their money. The report is widely circulated and has become something of a flagship for the bank alongside its monthly fund manager surveys. The Flow Show is an attention getter designed to make the readers sit up and think and adjust their portfolio if required. The most recent edition was no exception, and it contains some sobering data about equity flows. Bank of America says that the period of large net inflows into equities, which started in November 2020 and ran through to at least February 2022, is now over, with no significant new net inflows to the asset class being detected over the last 6 months. What's more, last week saw the biggest outflows from equities since June and the worst outflows from European equities since 2016. European stocks have now endured 30 weeks of net outflows. The selling wasn't limited to specific geographies, and the technology sector suffered its largest outflows of money since January 2019. Overall, that data shouldn't come as that much of a surprise because the problems facing Europe are well documented, and it's no coincidence that net new money stopped flowing into stocks in February just ahead of Russia's invasion of Ukraine. And of course, tech stocks have been pressured for much of the year to date as the market believes they will underperform in a rising interest rate environment. So, where are institutional investors and others putting their money? Well, bonds are starting to look attractive again on an income basis, with the U.S. 10-year Treasury bond yielding around 3.4%, double the S&P 500 dividend yield of 1.65%. B of A highlighted that bonds have seen net inflows in 33 of the last 36 weeks this year, though last week wasn't one of them. As for Bank of America's private clients, who have $3 trillion of assets between them, they remain exposed to equities, with 62.3% of their money in stocks. 19% of their funds are invested in bonds, which they have now been buying for 28 weeks in a row. They hold another 11.7% of their money in cash. Retail traders at Bank of America have also been buying defensive ETFs, including utility and low volatility funds. As an investment style, low volatility doesn't look exciting when its performance is measured on total return basis and then compared to other styles or factors as they are known. Low vol came third from the bottom in August and last in the performance table over the year to date. The bank's clients may be taking a contrarian stance here in the hopes that low volatility will perform in the final quarter of 2022 and into 2023. As for utilities, the S&P 500 sector ETF, XLU, rallied by 3.67% last week, boosted by solid gains in stocks like Constellation Energy and AES Corp, which bounced by 5.15% and 7.5% respectively.